If your bank shut down tonight, you'd have your money back by Monday morning. That guarantee is why Americans keep $9 trillion in banks without losing sleep. But the protection has invisible borders. Most people discover at exactly the wrong time. Deposit insurance exists because bank runs used to destroy economies. In 1933, after thousands of banks collapsed and people lost their life savings, the US created the FDIC, the Federal Deposit Insurance Corporation. The UK established similar protection in 2001, now called the FSCS, the Financial Services Compensation Scheme. Both operate on the same principle. The government promises to reimburse depositors up to a set limit if a member bank fails. This promise stops panic withdrawals. When everyone knows their money is safe, nobody rushes to pull it out, which means healthy banks don't get killed by fear. The FDIC covers up to $250,000 per depositor, per insured bank, per ownership category. The FSCS covers £85,000 per person, per financial institution. Those aren't totals across all your accounts. They're separate buckets based on how accounts are owned. A depositor means the legal owner of the funds. An insured bank means an institution that pays into the insurance fund. Nearly all US banks do. Credit unions have equivalent NCUA coverage. UK banks display FSCS logos. Ownership category is where it gets specific. Your individual checking account, a joint account with your spouse, your retirement IRA, and a trust account are all separate categories with separate limits. Here's how the protection stacks. Let's say you have $200,000 in a solo savings account at Bank A. That's fully covered. You also have a joint checking account with your partner containing $400,000 at the same bank. Each person's share, $200,000, is covered separately, so the full $400,000 is protected. You also have a $150,000 IRA at Bank A. That's a different ownership category, so it gets its own $250,000 limit. Total protection at one institution, $750,000 across 3 categories. If you opened a second individual account at Bank A with $100,000, that would share the original $250,000 limit with your savings account, giving you $300,000 across both individual accounts, but only $250,000 of coverage. The $50,000 beyond the limit is uninsured. What actually receives protection? Checking accounts, savings accounts, certificates of deposit, money market deposit accounts. The key word is deposit. If a bank accepts your money and promises to give it back with interest, and it's a deposit product, FDIC or FSCS covers it. What doesn't? Investment accounts, even if held at a bank. Your brokerage account containing stocks, bonds, or mutual funds isn't a deposit. You own securities, not a claim on the bank's promise to repay. Those fall under different protection like SIPC in the US, which covers up to $500,000 if the brokerage fails. But that's protection against the firm's collapse, not market losses. Cryptocurrency held in exchange wallets or apps is completely uninsured by FDIC or FSCS. Stablecoins, Bitcoin, Ethereum, none of it. When crypto exchanges fail, deposits vanish. The contents of a safe deposit box aren't covered because they're not deposits. The bank is renting you physical space, not holding funds. Payment apps like Venmo, PayPal, or Cash App sometimes hold money in non-bank accounts called stored value that don't qualify for deposit insurance unless the app explicitly partners with an FDIC member bank and segregates your funds into an insured account. Many don't. That balance sitting in your payment app might be unprotected. Here's the mechanism when a bank fails. Regulators, usually on a Friday afternoon after markets close, seize control of the failing institution. Over the weekend, the FDIC or FSCS arranges one of 2 outcomes. Option 1, they broker a sale to a healthy bank, which assumes all deposit accounts. You wake up Monday, your money is at a new bank, your account number might stay the same, or you get a new debit card in the mail. Option 2, no buyer exists, so the FDIC creates a temporary bridge bank and directly pays insured depositors, usually within 2 business days. Checks, ACH transfers, and debit cards continue working. For amounts above the insurance limit, you become a creditor in the bankruptcy process, receiving partial repayment as the bank's assets are liquidated. That can take years and typically returns 50 to 80 cents on the dollar. People commonly misunderstand the per bank rule. If your bank is part of a larger holding company, what counts is the legal charter. Bank of America and Merrill Lynch might feel like one company, but deposits at each separately chartered entity receive separate coverage. The FDIC publishes a bank find tool, bank find suite, listing every insured institution and its official legal name. If two branches share the same charter, they're one bank for insurance purposes. If you have $300,000 split across two branches of the same bank under the same ownership type, only $250,000 is insured. Another confusion: time delays. People expect instant seven-figure reimbursements. The FDIC covers $250,000 quickly. Amounts beyond that enter receivership, a legal process. During the 2023 Silicon Valley Bank collapse, regulators invoked a systemic risk exception to cover all deposits regardless of size, but that was unusual. The standard rule is the limit, and anything above it is at risk. Joint accounts create interesting math. If you and one other person jointly own an account, each person's share is separately insured up to $250,000, meaning a joint account can hold $500,000 in full coverage. Add a third joint owner and the coverage rises to $750,000. But many people assume joint accounts share one $250,000 limit total, leaving them underinsured. Revocable trust accounts, often called payable on death or Totten trust accounts, allow higher coverage if structured correctly. You can name up to 5 beneficiaries and get $250,000 of coverage per beneficiary. A trust account naming your 3 children as equal beneficiaries receives $750,000 in coverage. But the rules are specific. Beneficiaries must be named individuals, charities, or certain trusts, and the account title must clearly indicate the trust relationship. The limits exist for 2 reasons. First, deposit insurance is meant to protect ordinary savers, not to serve as a wealth storage system for the ultra-rich. The median US household has around $8,000 in savings. The $250,000 threshold covers 99% of depositors fully, while exposing large depositors to some risk, which theoretically encourages them to monitor bank health and spread funds across institutions. Second, the insurance fund is finite. It's pre-funded by premiums banks pay, not taxpayer money during normal operations, and currently holds about $125 billion, backing $9 trillion in insured deposits. That's roughly 1.3% coverage ratio. If the limit were infinite, the fund couldn't credibly guarantee all deposits, and moral hazard would explode. Banks could take wild risks knowing all deposits were protected, and depositors wouldn't care because they'd face no consequences. The UK's £85,000 limit is lower because the British economy is smaller and the banking system more consolidated. The threshold is designed to cover the vast majority of personal depositors while keeping the compensation scheme solvent. One edge case: temporary high balances. If you suddenly deposit $600,000 from selling a house, intending to move it within days, you're uninsured above $250,000 during that window. The FDIC offers limited exceptions for up to 6 months on certain proceeds from home sales, inheritances, or legal settlements, raising coverage to $250,000 above the standard limit. But these require specific circumstances and aren't automatic. Another edge case: foreign currency deposits at US banks. If your account holds euros or yen, FDIC coverage still applies, calculated at the exchange rate on the day of bank failure. Accounts swept into investment products to earn higher interest sometimes lose protection. Some banks automatically move excess checking balances into money market mutual funds overnight. Those funds aren't FDIC insured. The fine print matters. Deposit insurance is the system working invisibly until it isn't. Your checking and savings accounts at member banks are protected up to $250,000 per ownership category, per institution, with separate limits for individual, joint, retirement, and trust accounts. Investments, crypto, payment app balances, and safe deposit contents fall outside. The limit exists to protect everyday people without creating infinite taxpayer liability or encouraging reckless banking. If your bank fails, insured deposits typically become accessible within 2 business days. Anything beyond that, you're a creditor hoping the wreckage pays out.